Welcome to the Everyday Trader, everyone. This is Greg Jensen, CEO of OptionsANIMal. Glad you're with us today. Got an interesting topic to discuss today with Eric. Eric, glad to be with you today.
Yeah, Eric Hale, trader Oasis on OptionsANIMal. Good to be here.
So before we get into the discussion about what we're going to talk about, the massive pile of debt news announcement today, but I want to remind and thank everyone, first of all, for watching what we do. We're trying to give some good content here and give you our opinion of what's going on in the economy and the markets. And you do that by following us and liking the videos that you watch. So again, if you haven't subscribed to us yet, click one of the buttons, little bell down here, subscribe, and you'll get updates as to when we post a new video as they'll, as we feel it's timely. Sometimes it's a couple times a week, sometimes it's once a week. Yeah, thank you for those of you who are subscribers already. So the news announcement today is that the US Treasury just released the fact that we have surpassed 31 trillion in national debt for the first time. To put that into perspective, that's somewhere around $92,000 per person in the United States.
93,413. There it
93. There it is. 93.
Each one of you cough up a check. You owe $93,000. Everybody listening.
And most of those people aren't. Yeah, I shouldn't say most.
Per citizen, but per taxpayer, it's almost 250.
It's almost $250,000 of debt. So it's it's a real number, and this can be a scary number. I think it sometimes gets pushed around as a political tool to try to make statements from time to time. And so what we want to talk a little bit about is understanding the difference between debt, deficits, what it means for potential economic growth, what it means for potential taxes going forward, and ultimately what it means for the market. I think that's probably the biggest thing. So why don't we start with the definition of the difference between debt and deficit? Eric, I know sorry for those of you who already get this. I know, but sometimes people don't understand the difference.
Right.
So we talk about headlines.
Yeah, we talk about debt and deficit. First of all, there's generally two sorts of deficits that we talk about. One is a trade deficit, and that's basically what we import and export. So we're a net importer of products. So we tend to have a negative trade deficit. That is not anything to do with this. When we talk about budget deficits, it's the difference between what we spend and what we generate as a country in order to be able to pay. So Congress spending more than we generate is a deficit. Now, all of those deficits get added up to our total debt. So the US Treasury is the organization that funds the federal government. That's where the money comes from. And this is a graph that was released October 4th is the latest update. So total public outstanding debt, which is made up of a combination of intergovernment holdings and total public outstanding debt. So the government loans money to itself, which is interesting that happens. But it is what it is. But right now it's this big number, that this 31.1 that's an all-time high that's certainly getting a lot of attention. And this chart here, this usdebtclock.org, I think is appropriate for the month of October because we talk about scary things. This is certainly a very scary, set of data to process, especially when you make it personal. Talking about each one of us who pay taxes owing somewhere near $250,000.
Well, and I think one of the biggest misconceptions too, while we're talking about who owns that debt, on a personal level. On our personal finance level, we get this experience of, if you go borrow money, whether it's to buy a car or to buy a home, or maybe you have to borrow money from someone to pay an unexpected medical bill or something like that, you're borrowing it usually from either a financial institution or from a person. And you have this obligation associated with that. And that's not saying that this is any different, that, the US does owe money to someone. And the unknown is, I think, or maybe the misconception is for a lot of people, is that, well, that's all owed to China. I know I hear that talking to people all the time of, China owns all of our debt, so they essentially own us as a country. And it's very far from the truth as to who actually owns that debt. To be honest, of that 31 trillion, somewhere in the neighborhood of about 24 of that 31 trillion. So the bulk of it, right, is actually owned by the public, you and I. Our 401ks that we have, when we go to make that election at our job to say, I want to put, 60% in stocks and 40% in bonds. What most people don't realize is that election to click 40% into bonds, that's US debt for the most part. That term bond and debt are the same thing. And so I just want to clarify that, there's a lot of times, especially when we get in political election seasons, a lot of fear mongering that goes around about, we owe 31 trillion in debt and, China and Japan own us because of it. That's not to say that China and Japan don't own some US treasuries and US debt, but it's a really small piece compared to this overall massive pie that we're talking about.
China at one point was the largest holder of US debt, but I think that's 4 or 5 years ago. And I think it's intentional that China has tried to remove themselves. I mean, there was sort of a euphemism going around that if we went to war with China, we'd have to borrow money from China to fight them. That's certainly changing. Actually, it's the United States that's the largest holder of our own debt. And a big portion of it, as you mentioned, is the Federal Reserve.
Yeah. And again, that's still just the other portion, right? So we're talking about, the 24 trillion, which is the public stuff that's held by, whoever, but most of it, you're right. The other 7 trillion or so, that's held by governments or other, private investors. That's monies that are owned by, you said it, 40% of that debt is actually owned by the Federal Reserve. And to be honest, that's one of the things as we look at what's going on in the US bond market. And I know we talked a little bit about this last year, is that's a disconnect in the fact that the Federal Reserve for the last couple of years has been that buyer that they stepped into the bond market and been the one buying, and they're no longer at the buying table. They're actually on the other side of the table right now, considering selling bonds and unwinding their balance sheet. And so that's why you're seeing downward pressure on bond prices, which is putting upward pressure on interest rates, which, as we look at this massive pile of debt, that's one of the biggest concerns on my front is this is starting to become really expensive to service. I mean, it's already expensive. It's somewhere in the neighborhood of, $1 billion, just shy of $1 billion a day that we are paying in interest on that debt. And that starts, I know that's a really massive number, but when you're talking in the trillions, it really piles up quickly as to how this debt costs us a lot of money. And the question I think you have to ask is, how long can we do this before we risk becoming Venezuela?
Well, you get a little bit ahead there. I totally
Sorry.
So looking at this graph, this looks like maybe a SpaceX rocket launch, where things, if we go back in history, that's one graph. I'm going to share another graph from my favorite website, Fred, by St. Louis Fed. This is the same data. It's not as updated. So they update this quarterly, but it's the same data. And looking at this sort of, scary takeoff and acceleration of debt. And of course, this huge increase that happened during COVID, where we put a bunch of stimulus into the economy. We paid through it through debt. And there's a time of reckoning. And when you talk about those, billions of dollars and trillions of dollars, it's overwhelming. I did want to just share one thing that's important, and that is it's sometimes hard for people to see non-linear relationships. So sometimes we use logarithmic scales. Now, the distribution of money has always followed a power distribution, not getting too wonky in math, but we see logarithmic changes in the population of rabbits and all sorts of things in the world, and money follows the same pattern. So when we look at a logarithmic graph, the debt doesn't look as scary. It almost does look like a linear, and this is probably more appropriate to look at in terms of making things look a little less scary. But you brought up an important point, and that is that the cost to service the debt. And that, I think, you go back to this clock here, and I took it off because the truth is this gives me a ton of anxiety. Looking at this really causes me to stress out. But public debt is different than debt that you and I have when we buy a home or a car. And I think when we think about interest rates that we have to pay, it's wasted money, and that's you're thinking, man, I didn't buy that vehicle and get the rate that I got. If I paid less, I would have saved money. And there's certainly, that is a real important point. And if things get too high, it is going to become a problem. And I think there's a point that we could get to if we're not careful. And so we've got these people that are hawks that are trying to rein in spending. Now, you know that I am a card-carrying member of the Libertarian Party. So some of the stuff I'm gonna flip. There's my membership card. So I am a dues-paying, card-carrying member of the Libertarian Society. So talking about how the system works and how I'd rather have it are two different things. So I'm going to go a little bit out on a limb here and probably defend the current policies that we have. And the next thing I wanted to look at, we talked about just instead of looking at a logarithmic, looking at a linear. That makes me a little bit less stressed out, although these are still pretty significant increases. As you mentioned, our cost is something on the order of $1 billion a day. How do we put that into perspective? Because it's hard. We start talking about all these zeros and what's a billion, what's a trillion, between friends. One of the best ways to take a look at this is to sort of normalize the data, comparing it to GDP. So there's two lines here. This is a blue line that is that same data, that public debt data, but expressed as a percentage of GDP. And this is the thing that is getting people to freak out, is that if you look at the blue line, our debt as a percentage of GDP is going up, and that's a problem. So gross domestic product is a representation of all business activity across the United States. And we charge taxes on that. So our money that comes in is somewhat related to GDP. So looking at the other data, and this is the federal outlays, when this is essentially the service, what we have to pay to service that debt. And that's what the red line is. So as a percentage of GDP, the cost to service that debt is really not as high as it has been, as we saw like in the 80s or in history. In fact, if you went back to the 70s, we're more in line of that. Now, this is only updated annually. This data is not as frequent. But this is the sort of stuff that when we ask politicians or policymakers, should we be concerned about that? This is the data that they're going to come back and look at. Now, we are going to see a big number at the end of 22. It's probably going to be up here, which is definitely some cause for concern.
Yeah, because I was just going to say, if you look back at the peak of that graph of the red line back in the late 80s and early 90s, that reflects, of course, the really high interest rates that were prevalent back at that time. And so the cost was more expensive. But I guess the point you're making, let me see if I'm understanding you correctly, is it's okay to borrow money as long as it's facilitating growth.
Right. If you're buying a bigger house and taking on more debt, that's fine, as long as your income also goes up and mortgage rates going up, getting higher. If you're getting more salary, that's fine. As long as your salary is sort of the same analogy as what I'm trying to use here, is we've got an expanding GDP. And I don't know, did you see the Atlanta Fed? I didn't mention this to you earlier, but Atlanta, this was last week, Fed GDP Now. We mentioned it, I think, on the OptionsANIMAL Weekly.
Yeah. They raised it.
Forecasting it. This was forecasted to be close to zero, and now they're revising their estimate up, which is getting a lot of attention. So there's some arguments to be made that this recession, that whether we're in it or not, this would show that we're not in it because it hasn't gone negative yet. That if it is one, it's going to be short-lived. Yeah. So debt's a problem. Servicing the debt is really the issue that we should be looking at. Now, I'm all for budget cuts and reining in taxes and spending less money, but from stepping back from a macro and sort of an impartial, taking my personal opinion out of it, this is what I look at, which allows me to sleep at night and not be as concerned.
So you're somewhere in between MMT and Ron Paul.
Yeah. So MMT, you didn't talk about MMT, and this is this theory that is being sort of an extension of John Maynard Keynes. You hear about Keynesians. Economists believe that they can that basically all GDP growth that ends up being a result of government stimulus, so that the government can direct things by putting money in certain places and lowering or adjusting the Fed funds rate to stimulate the economy. So it's a very sort of central planning, hands-on, and MMT is that on steroids.
It's basically Japan, right?
Well, it's basically the United States, if you ask me.
Yeah, I guess that's true. Lately, for sure.
Right. Stephanie Kelton, who has actually a pretty good TED Talk if you're interested in learning more of this. So Stephanie Kelton is the professor from Stony Brook University. Stephanie Kelton. And there's a TED Talk. You could Google. Yeah, Stephanie's The Big Myth. So she wrote a book that's called The Myth of Government Debt and Deficits. And her argument is essentially there's no such thing as a debt, because that money is actually a stimulus. So it's all money that goes somewhere. So, and she has a chart in here somewhere that shows. I don't want to, maybe I shouldn't pull it up, but she's got a chart in here somewhere that shows there's that graph that shows so this is the deficit. And then on the other side of that, I'm not going to spend time going in there, is public funds that have been spent. So the inverse of a deficit, it's money going someplace.
Well, and that's the point I was going to make when you were talking about the massive amounts of interest that are being spent. I know I was the first one brought up, but you reiterated it. The point, where is that interest going? I know from a personal standpoint, you made the analogy, when you're buying a car or you're buying a house, that interest is killing you as an individual because it's going into someone else's pocket. But if you think about who holds that debt, well, again, we as investors in the bond market are the number one beneficiaries of that interest that the U.S. government is spending. So if the government changes policy radically and says, we're not going to go into debt anymore, we're not going to be issuing bonds, well, all of a sudden, we as investors, especially those later in their investing years, if the bond market evaporates and there's no public debt market for us to buy these bonds, well, then we don't have that interest coming anymore. So there is a positive side of this big giant debt thing. I know I was going to try to be the antagonist today, but I feel like I'm arguing for it's okay to be in debt too. The question, I think, and maybe we can get to this point, is how much is too much? Is there a point when the government spending gets so high and the cost of carrying that debt, could it break something if we continue to escalate it at the pace that it's going?
Right. And sort of springboarding back off of this. So looking at debt as a percentage of GDP is another way to look at it, and looking at the numbers slightly different. So total debt, outstanding debt as a percent of GDP. This is a chart that shows the countries around the world by different colors. And United States is, and here's let me see this. That's not the graph that I wanted to show. I've got too many browsers open here. Yeah. Where's the heat map that I had? So there's a heat map that shows the various countries and where we are. Trading economics There we go. Yeah, this is the one I was showing you before we started. So this is right now sorted by GDP. So United States is China, Euro area. And this lets us look at a bunch of different things. It's this debt to GDP that we need to help to put things into perspective. And number one on the list is sort of the poster child for runaway inflation and how fiscal and monetary policy shouldn't work. We talk about Venezuela with an inflation rate of 114%. It's just astronomical. And this is the poster child for why there is a limit, I think, in terms of how much debt is too much. So if we look at the other countries that are on here, I'm going to get rid of some Mozambique and some of these other ones. Let's just look at the major countries and compare where we are relative to major economies globally. Here's the United States coming in at 137.2 debt to GDP, and with Japan being way, way out there ahead of us. So as at 266, Italy and Spain, they have their own problems because they can't print their own currency. They're part of the EU. And this is why we see the EU doing special things to help Italy and Spain. But here's Canada and France. France falls into the EU as well, and the UK, all right, and not too far from 100. And I think looking at these perspectives, we're not the worst horse in the stable here. We're not that far off from some of these other developed countries. So from this perspective, I don't think the debt, it is a problem. I think, any thoughts on this before I go to that last part there? We're going to talk about.
No, I think the biggest, point again to that is what you said, is the countries that have the ability to print their own currency are the ones that I don't think have as big a risk with this debt to GDP situation. I think Italy's and Spain are both real legitimate concerns for their localized economies. But we have seen over the last decade, as we've seen crises spike up in Italy and Greece and parts of the European Union, the EU will step in and bail them out from time to time in special bond offerings or purchases of their individual government currencies or government debts, as not to help them survive those short-term cash crunches. But yeah, the question then, of course, is, well, if you have the ability to print your currency, now you have the whole talk about inflation.
And a standing army. If you have a standing army and you're not on the gold standard, which, so if you're not on the gold standard, you can print your own currency, a fiat currency, which we do. And certainly there is a limit. And we saw, going back like Venezuela and some of those other countries, we could definitely run into some potential risk. So the other reason I think to know that we're sort of in a safe zone is to some other data that I got from Trading Economics is taking a look at the debt rating of major countries. So Trading Economics provides consumer debt rating, they provide a list of debt ratings from the various debt agencies. And it's hard to look at in that data. So I actually exported it into Excel. So we have Standard & Poor's, Moody's, Fitch, Dun & Bradstreet, and then Trading Economics does their own credit rating score. So these are the credit rating scores for the major countries. And the United States comes in, depending on who you're looking at, Moody's, Fitch, and Dun & Bradstreet were right here at the top with S&P 500, S&P Standard & Poor's credit rating. We're one notch below AAA. We're AA plus, and that was, when did that downgrade happen?
2011.
Right.
Pretty ugly market. 2011 when that happened.
Yeah, that was
not any worse than we've had this year. Let's be honest, but
right, for sure. But looking at these numbers, I mean, Austria is where we want to be, right? So all hail the Austrian economics at the top of the list. With
Australia. Sorry, I got to correct you there.
Oh, damn, it's Australia. I'm sorry. Austria is below us. I'm sorry. Austria. Wait, there's no kangaroos in Austria. I had a friend who had a T-shirt who's Austrian. Said, I'm sorry, Australia. Okay, I'm excited about the Austrian economists, Hayek and Mises, but all right, we'll leave it alone there, not go down that rabbit hole. So this is where I sort of want to dovetail things and wrap up our quick discussion today. In terms of should we be concerned, going back to this really scary debt number, which is scary, and definitely there are parts of this that need to be reconciled. We have some major issues that we're going to face on Social Security and Medicare coming up, and those are not too far away. We're about an election cycle away from those becoming crisis levels. So there are parts of the debt that are a problem, but I think stepping back and looking at debt in terms of peers, looking at in terms of GDP, we are not that far off from where we've been in the past. It's been worse in the past. And then looking at credit ratings, I think these would be the warning signs to know that when we're getting closer to our debt becoming an issue. Because right now, while we're not the prettiest, we're definitely one of the best looking horses in the glue factory.
I think I'll add one more thing to that as another thing to look at, and that is just looking at the market itself. I'm not talking the S&P, but the actual bond market. The supply and demand there, when you see bond prices dropping, that means there's not as many interested buyers at the current interest rate. And if we see bond prices continue to go on the path they have this year, and they continue to show a lack of demand for bonds, because again, like I said, the Federal Reserve has stepped away. They're not buying. If the public or other governments don't start to step in eventually and buy those bonds, that's when you may start to see this rating decline, or get declined by one of these rating agencies, because the interest rates are going to continue to ratchet up as fewer and fewer people demand those bonds, at the same time that our government is demanding more and more money to operate the government. And so that's that deficit that we were talking about earlier. So it's that's another sign to look at. I agree. This will be the big sign. If we see one of these agencies downgrade, that's when you can see some concerns start to come up about that massive pile of debt.
And the US dollar continues to strengthen too. So I think the warning signs are, there's reason to be concerned, but I think as far as being concerned about the total debt, it bugs me to say this, but I think is this going to cause us a recession? I'm in the camp that we have a long way to go before it becomes a real problem.
Okay. Good to talk to you today, friend.
All right. Thanks, everybody. Hope this is helpful. Any questions, ask them down below. Any other topics you'd like to talk about, let us know. Don't forget to like and subscribe and hit that little bell. You get a notification whenever we put a new one out. Thanks, everybody.